I'm speaking today to Craig Donohue, the Chief Executive Officer of CME Group. CME Group, as Craig would explain to us shortly, is the world's largest derivatives exchange. And we want to talk to him about how his business has been evolving and how exchanges in general are evolving globally in what needs to be done, and to find out how his business is going and how the underlying industries that you serve are evolving from the global economic crisis, and how's that serving the exchange business in general. Thanks for speaking to us today, Craig.
My pleasure. Thank you.
And I noticed that your results have been somewhat challenged, although what you're essentially saying is that the trading volumes have been increasing in some of the businesses that you operate in.
Well, what I would do is put it in perspective and say that we've had a 30-year run of compounded annual growth rates of 18 to 22% in our business and in our industry, and over the course of the last 7 or 8 years, compounded annual growth rates in the roughly 30% range. But as we all know, we've experienced a major world economic and financial markets crisis, and so it's very difficult to judge the volume activity today versus year-ago levels when we were at the sort of market peak, and then, as we've all experienced, we've had this major sort of disruption in the economy and financial markets. But what we're seeing more recently is, quarter over quarter, very good growth, particularly in the interest rate and fixed income, in the foreign exchange, and in the commodity markets. So we're beginning to see tangible evidence, I think, of a good kind of recovery of stability in the financial markets.
Of all the product sets that you have, interest rates, equities, forex, commodities, alternative investments, which would you say are your anchor product sets, and how's that been evolving from the crisis?
Well, I would say all of them at this point, because we've become, as a result of our acquisitions of the Chicago Board of Trade and then the New York Mercantile Exchange and COMEX, we've become very diversified. So,
but you're the kingpin on the commodities front.
In fact, we're the kingpin in every segment. I mean, we are the world's largest marketplace in fixed income and interest rate derivatives. We're the world's largest marketplace in equity derivatives and commodities and energy.
Something that's not been discussed very much today is how the derivatives market is performing in today's environment, low interest rates, with inflation hanging out there somewhere. How would you describe the derivatives market in this environment?
Well, it's all different. I mean, the fixed income and interest rate markets have been, very profoundly affected by the stresses in the credit and lending markets generally. And of course, we've got, a high degree of monetary policy intervention in the marketplace,
right.
And so that has an effect on interest rates and interest rate movements, expectations, volatility, and whatnot. So that area for the first or last 6 months of 2008 were very, very difficult. We're coming out of that now, and we're beginning to see people with different expectations out farther over the yield curve in terms of what interest rates will look like. In the commodities area, I mean, you're going to continue to see people, try to, seek hedging opportunities for inflation risks by accessing commodity and energy markets.
But I noticed that as the markets recovered, a number of players taking on hedging risks have been on the wrong side of the market, in effect. And in fact, it's affected a number of industries like the airlines, like even countries like China. In that sense, do you see a correction taking place in the commodities, on the commodities front?
No, I don't think so. I mean, I would say, first of all, in the example that you give, I mean, there were a large number of airlines who, in fact, weren't hedging the price risks of fuel, which one has to question the prudence of not hedging the risk.
That was before the crisis, and then during the crisis, they overhedged in some.
Right. So I mean, hedging has to be done carefully and prudentially to begin with. But I think the other side of that is that, I mean, normally speaking, if you're truly hedging a risk, you're either going to see that the risk didn't materialize, in which case the hedge is like an insurance premium, and you have insurance but you didn't use it, or correspondingly, the risk did materialize, and so you had some economic impact. The hedge offsets the economic, detriment that you've suffered. So it should balance out in the long run if you're doing it carefully.
In the next 2 quarters, do you see a kind of a rebalancing in terms of how hedging is going to work out, especially in oil futures and some material?
Well, I think the most valuable lesson that has been learned is that you have to hedge these risks, and you have to do so carefully, and to not do so subjects your company and your shareholders to enormous risks that you can't otherwise deal with.
Give us a sense of what's happening on the alternative investment front. With all the conversation going on to bring as much of OTC online as possible, do you see activity on that front? Do you see opportunity in new trading instruments?
Well, I think where we're focused for the over-the-counter markets is really on the post-trading clearing, processing, and risk management.
Okay.
So what we call central counterparty clearing services for the over-the-counter markets. And, it has a number of important benefits. First of all, we do, what we call twice daily mark-to-market. All positions are fully margined and collateralized with very high quality collateral. And so it's a zero debt system. It tends to instill much more confidence, even in the trading side, because we're no longer worried that we have a bilateral exposure and perhaps our counterparty will fail to perform. You have instead the guarantee and backing of a well-regulated, very well-capitalized, fully margined clearinghouse. And so there's tremendous value in that equation for us. And of course we do, portfolio-based risk margining. Because of the success of our business on such a broad basis, we provide a lot of margin and risk management efficiencies.
I can imagine the banks being both your clients as well as somewhat of a competitor, because they would want to have the trades in-house in that way. What are the banks doing on the derivatives front today, to take some of that risk off their books in a sense? At the same time, they need to have exposure because, for the trade finance business, for the forex business.
Yeah.
Give us a sense of what's happening on the banking front.
I think our interests are converging and aligning better than they ever have in the following sense, which is that listen, first of all, the over-the-counter derivative markets and the listed futures and options markets are very complementary and synergistic generally. The listed markets are the basic building block tools of hedging and risk transfer, off of which the banks can, construct more complex and tailored risk management hedges and transactions for their customer base. At the end of the day, they have the net risks of their portfolios that they hedge into the futures market. So generally speaking, we're much more collaborative and complementary than we are competitive. But they have a very significant business in their swap dealing activities. We have a very significant business as an exchange. And I think there's always the concern that, we're moving in each other's direction. On the aspect of OTC clearing, what I see from the banks is they're much more oriented now to, what is their cost of capital, what's the risk-adjusted rate of return for the different businesses that they operate, whether that's prime brokerage services or proprietary principal-based risk-taking activities. And central counterparty clearing plays an important role for them in reducing their regulatory capital charges, making the business more efficient, reducing the risk, the credit risk component of the business.
Yeah.
So I think it's changing.